Okay, please confirm. Can you see my screen? Okay. So, please, can someone give us an overview of what we discussed in our previous class? So you can start from what is it called? The methods of valuation. Please, let's just use 3 minutes. Please, 9:11. We can use 4 minutes for introduction, right? So please, can someone give us an overview, a quick recap on what was discussed in our previous class? Please, just 3 minutes. Hello, are we still together?
Yes, sir. Good evening, sir.
Good evening. Okay, Bashirat. Good evening. Let me hear from you.
Okay.
As
So we
discussed.
discussed about methods of valuation. So under that method of valuation, there's asset-based method, there's income-based method, and there's dividend-based method, and there's also the one of free cash flow, free cash flow to firm, free cash flow to equity. Then for asset-based method, there is three types: historical cost, realization or liquidation method, then the replacement one. So it depends on the question that is given to you that you determine which one you are going to use, whether it is historical cost or realization cost or replacement cost. So for historical cost, the one is just that your total assets minus your total liability. So you get your market value under asset based method. Then under income based method, there are a lot of formulas for you too. There's the one of price earnings ratio. Then you cross multiply, or you multiply your price earning ratio times your earnings per share to get your market price for it. But the main thing we are looking for is the market price or the market value of the share of the company that we want to acquire. So the main reason for valuation is just to get to determine the market price of a company, of the target company. So for the income based method too, there is one for price earnings ratio, there is one for dividend yield, and there's one for earnings yield too. And those of them also have calculation for it. Then for dividend yield method too, there's one for without growth and with growth. The one without growth is just like the normal way we used to get cost of equity, that we get the formula. Cost of equity is equal to dividend divided by market value, SDIV. So we just cross multiply, then we look for the market value of the SDIV. Then there's one without growth, the one with growth. Then the one with growth, we do it according to the growth that is given to us in the question. And there's one of present value of cash flow. Present value of future cash flow, that one means free cash flow. And it also has something like infinity, till thereafter. Till thereafter means till infinity. That is after we have done that, after I've gotten the one for example, if it is for the growth is for 5 years or 6 years, we're going to do it for the 1 to 6 years. Then once I have done with that, I have gotten the total market value for it, and we have applied the growth for that 1 to 6 years. Then we do the thereafter one using the formula. Then we use the PV of that last PV of that last year, whether it is 50 or the 60, we use the PV, then times the growth rate, then divided by the cost of equity minus the growth rate. Then we get the value for till thereafter or infinity. Then we add it together, okay, we get our total market value for it.
Okay. That makes sense. Makes sense, right? Okay, makes sense. So in today's class, thank you so much, Bashir, for the summary, right? It makes sense. So in today's class, we'll look at illustration 2. This illustration 2 question is adopted from I can find I can pass question. May 2023, question 1. So if time permits us, we will also solve May 2023, question 7. Right, you see more valuation questions in May 2023. Right. So class, please who will read? Please who will read May 2023, question 1.
Yes, can I read?
Please go ahead.
Okay. Calculate the value of ZL based upon 1. The use of comparative PE ratios. 2. The dividend valuation model. 3. The present value of relevant operating cash flows over a 10-year period. 4. Provide the evaluation of each of the 3 valuation methods in 1 to 3 above. 4. Recommend whether KK should go ahead with the offer for ZL. Then B. The regulation of takeover varies from country to country. Outline the typical factors that such a regulation includes.
Okay, thank you. Thank you so much. So the requirement is that the value of ZL based upon, meaning that we are to determine the market value of, we are to determine the market value of the question of Z based upon the use of comparative, which is PE ratio, the use of dividend valuation model. We don't know if it is dividend with growth or without growth. Then the present value of relevant relevant operating cash flows over a 10 years period. Then provide an evaluation of each of the three valuation methods above. Recommend whether should go ahead with the offer for Zell Air or not. So we need to um we need to recommend if they should go ahead for the offer of Zell Air or not. Now, KK, a company quoted on the stock exchange, has cash balance of 230 million, which are currently invested in short-term market deposits, meaning that KK is a quoted company. It has cash balance of 230 million, which are currently invested in shares in short-term money market deposit. The cash is intended to be used primarily for strategic acquisition, meaning that they want to use this 230 for acquisition, right? So, and the company has formed an acquisition committee with a remit to identify possible acquisition targets. You can see this question is leading to acquisition, right? We're supposed to take merger and acquisition, but we'll take merger and acquisition we'll do it on Wednesday, right? Tomorrow, which is tomorrow, right? So you can see that one of the reasons of valuation of a business is acquisition, right? So they are looking for a possible acquisition. Of course, when you're looking at a possible acquisition, you have to determine the value of that company, right? You have to do what? You have to determine the value of that target company that you want to acquire, right? Acquisition. Now, the committee has suggested the purchase of ZL. So now they are not looking at alternative to purchase of ZL. A company in a different industry that is quoted on the alternative investment market. Can you see? So they've identified ZL. Although ZL is a quoted, approximately 50% of its shares are still owned by three directors. Plus, meaning that the ZL is a quoted company, right? Approximately 50% of its shares are still owned by directors, meaning that 50% of, of course, when you see we have the likes of, we have a lot of quoted companies in NGS where you can just go and check, and you will see, even in the audited report, publicly audited report, you will see the numbers of shares owned by some of the directors, right? So, but in this case now, 50% of the shares are still owned by the what? By the directors. Now, these directors have stated that they might be prepared to recommend the sale of ZL. Now, class, if 50% are still with the directors and they are now recommending that, oh, we want to sell this business, so definitely there should be something in return to the directors at the same time where you want to so definitely they've been anticipating for something, right, for that acquisition, for them to say, oh, they want to recommend, they want to sell it, right? Meaning that if they want to sell it, they have shares, they have to pay them, they have to pay them off, right? Now, but they consider that its shares are worth 220 million in total. So now the directors believe that, but they consider that its shares at, what is this? Sorry. Its shares are worth 220 million in total. So meaning that the shares of ZL in total, the value it's worth, that is their own quote, that it's worth 220 million in total. Plus, we have the summarized financial data. This is for the acquiring company, or let's say the main company. Let me just use that name, right? This is the main company, and this is the company they want to acquire. That is the target company. So we can see that the financial information is given to us as this, right? We're given all this financial information, the dividend, the long-term finance, so the information about their current share price. You can see that the one of KK PLC is higher than the ZL PLC, right? So we have earnings yield. The first one is 10.9, where we have 19.2. So this is their dividend paid, 7.8%. This is the equity beta. The both companies' equity beta is less than 1, indicating that the company stock is less risky, right? So we have industry data. Here we have average PE ratio. Then we have average PE of companies recently take over based upon the offer upon the offer price. We're given the risk-free rate of 16% and the market return of 14%. Then the rate of inflation is also given in this question and is expected to remain at approximately this level. Class, more information. Expected effect of the acquisition. So meaning that after the acquisition has taken place, what are the things we should be expecting after the award? Expected effect. What will happen in the in the acquisition, right? Now, 50 employees of ZL would immediately be made redundant at an after-tax cost of 12 million class, meaning that after the acquisition has taken place, they will have to make them redundant. They will have to pay a redundancy fee to 50 employees of ZL, right? They have to pay. Of course, who will pay that is the ZL company. They are the one that will pay all those things. Redundancy fee, right? 12 million. Now, pre-tax annual wages savings are expected to be 7.5 million at current price for the foreseeable future. Now, class, when something is in current price, what does that mean? The current price means what? This 7.5 means what?
Real money.
That is the real. Good. That is the real. Okay. Thank you. So meaning that the pre-tax annual wages savings, so they will have a savings of 7.5 at current what? At current price, right? If this acquisition takes effect. Now, another thing that could happen is some land and building of ZL will be sold for 8 million, meaning that if the company want to acquire ZL, they have to sell it. You know, these are cash flow that we need to consider. We have to do what we have to sell it. That is after tax, right? So next we have the pre-tax advertising and distribution savings, right? So we still have a savings here. Can you see? We have pre-tax. You can see that we have pre-tax savings at current price, meaning that inflation is yet to take effect, and that will be what? That will be real cash flow. Now, next we have the three existing directors. You know, we should not equally forget that at the beginning of this question, it was stated that 50% of the company shares is being owned by the director. Of course, when you want to dispose the share, the company, they need to, yeah, you have to pay them. You have to pay them, right? That portion. Now, the three existing directors of Zella would each be paid 1 million per year for 3 years, meaning that the directors, we have to pay them. We have to pay them, and it will we have to pay them 1 million for 3 years for consultancy what? For consultancy fee, right? This amount will not increase with inflation. Class, what does this mean? If they say this amount will not increase with inflation. Class, what does that mean? Considering the fact that we need to pay the director off, right? Now, I just want us to, please, I want you all to understand this question. It is not complex, right? It is not complex, right? Now, the amount would not increase with inflation. Now, if the amount will not increase with inflation, what does that mean? Class, if the amount will not increase with inflation, what does that mean?
It means for the whole 3 years, the amount will remain same, no growth.
Okay, it means it will remain 1 million throughout the period, right? This amount will not what? Increase with inflation. So if this amount will not increase with inflation, what it means is that it is a real cash flow, right? What it means is what? It is a real cash flow, because if something is not increasing in line with what? In line with inflation, right? If something, sorry, I said this,
I thought
sorry.
it's money, man.
Money, yeah, sorry. So that is what? That is money. right? Thank you so much for the correction, right? So now we need to start from the PE ratio, all right, before we move to the way we will do a lot of work is just the cash flow part of it. Any other information still remain the same. So suggested solution. Suggested solution, you can check ICANN question May 2023 question 1. Suggested solution Z Z self. Okay. So we have Roma figure 1. We have to start with the PE ratio. We have to start with PE ratio, right? The question says comparative, right? Use comparative PE ratios. PE comparative PE ratio. Now, when they say something is comparative, means that probably from the previous year, from the recent thing that just happened, right? It is comparative, maybe from the previous year, in addition to the current year, right? That is comparative what? Comparative PE ratio, right? So what do we want to achieve? We should not forget that we have targets is to determine market price. So if we want to do this, we say market price is equals to sign is not working. I don't know what happened to my keyboard. Okay. I think someone is against us. My keyboard is not working. That's fine. So market price equals to what? Price. What is the formula, self? PE ratio, right? Hello? Hello?
Yes, we are
P
with you, sir.
ratio times earnings per share.
Any per share.
Okay, that's fine. Times earnings per share. So now the question now is, which of these PE ratio are we going to use? Is it the average PE ratio, or is it the average PE ratio of companies recently taken over based upon the offer price? Which one are we using? We should not forget that they just want to acquire acquisition. We're talking about acquisition, right? So which one are we going to use? Is it the first one or the second one? Yeah.
To me, it's the first one
Why? Why is it the first one?
because they said average PE of companies recently taken over based upon recently taken over.
You've seen it, right?
Yes, sir. Yeah.
So that's and they want to acquire now. So they
Okay,
have
yes,
to,
sir.
yeah, it has to it has to be the, what is it called? The recent PE ratio, right? So and it is for ZL. So the P ratio is 7:1, which is 7 divided by, so which we normally say 7:1 means 7 divided by 1 times. So what will be the earnings per share? That is profit after tax divided by the numbers of shares. What will be our profit after tax for ZL? What is profit after tax of ZL? Class. What is profit after tax?
5,510.
35,510.
35,510. Good. So if profit after tax is 35,510, so what will be the numbers of shares? What will be the numbers of shares? What will be the numbers of shares?
Numbers of shares would be,
How many? What will be the numbers?
400,000.
Okay. That is 5,000.
20,000.
is what?
Divided by
20,000.
Is it 20,000, right?
20,000.
Okay. This is 35,510. Please, 35,510 divided by the numbers of shares. And you said the numbers of shares is what? What's the numbers of shares?
20,000.
How
20.
did you get it? The 10 is
How
10
did you get
kobo.
the 20,000?
It's
Uh,
10 kobo. Is it not 5,000
Yeah, I'm
divided
getting
by
50,000.
10 kobo?
Yeah, I'm getting
Yes.
50,000.
5,000
Yeah.
naira divided by 10 kobo. What do you have?
It's 50,000.
Oh,
It's 50,000.
50,000.
50,000.
50,000 shares.
50,000. Yes, and our EPS is supposed to be 0.71.
Our okay. Any EPS, okay, no, let's just do it direct so that we just move from it. Right. So what do we have? What is the market price? What is the market price? I don't know what happened to my I think I just need to copy this. Please now give me figure so that we can move. What is the market price?
4.97.
Okay. 4.97 naira per share. So market value. Please, you can mute your mic. Market value is equals to, you just multiply it by the numbers of shares. 97 per share times the numbers of shares is 50,000 shares. So what do we have?
248,570.
24.
248,570.
248,570. Okay. 248,570. Okay, that's fine. We are done with this. So next. So the next we have dividend valuation model. Dividend valuation model. Now the question now is, which of these is it dividend with growth or without growth? Is it dividend with growth or without growth? Okay, let's check it out. Average dividend growth during the last 5 years. So average dividend growth within the last 5 years. So what do we have? So is it dividend with growth or without growth, class?
Dividend with growth.
With growth.
Okay, thank you. So that is dividend with growth, right? Because they say average dividend growth during the last 5 years. It means that there is a growth in what? In dividend. So what is our formula for calculating? Okay, so we can have dividend with growth. So we can have dividend with growth, which is the market price. Market price is equals to, what is our formula for calculating dividend with growth? The market price. What is the formula?
DO bracket 1 plus G over KE plus G.
Mm-mm. D
GO,
one,
growth rate.
yes, plus G.
1 plus
Okay,
G.
1
okay,
plus G.
okay, okay, let me just copy this.
Mhm.
So so we have this to be our formula for calculating the market price, the cost of equity minus the growth rate given to us in the question. Class, don't forget that sometimes the growth rate may not be given to you in this question, and you may be given some elements that we use. We have two method of of how we can get our growth using the extrapolation, or we use the Gordon's growth model, right? I think one of the pilot question, if you look at the first, I think maybe pilot question 1 or 2, you will see that one of the compulsory questions there, we solved that question in class. If you look at it very well, right? Have you checked it? So we've solved one of the, what is it called, the compulsory question. Please, how many of you check the pilot question? Hello.
Yes, sir. I think I've checked the pilot. Yes,
Okay.
sir.
Okay, but the question 1 there, we've solved that question in class before now, which is on cost of capital and specific cost of capital. So
Excuse me, that's not pilot question. What is it? What is it meant
no,
for?
it's just questions that I can set. It's just normal questions.
That they are likely to test a bit.
No, I wish to tell you. Everybody is just solving
I
questions.
define AOC up and down.
No, it's just there for like a guide. It's not that is what we come. I can very smart people like this. So, um, anyways, all things being equal, right? All things being equal, in our intensive class, we'll see how we can at least maybe we just pick like 2, then add to what I have. So we just pick like 2 questions from there. So, so what is our dividend in this question? Okay, we need to calculate cost of equity. Let's quickly calculate the cost of equity. So which method are we going to use to determine cost of equity based on this question now?
CAPM.
Okay, we are using CAPM, right? All right, so risk-free. Is it risk-free? Okay. I don't know what happened to my mouse. My keyboard is not working here. So plus equity beta, then market return. Is there a risk premium? I think there is a risk premium. They give us risk premium. There is a risk premium. Thank God, though. I'll just open the bracket like that. Right. So this is cost of equity equals to risk-free. What is our risk-free given to us in this question? What is a risk-free?
6.
6. Risk-free is 6 plus what is the equity beta of ZL? What is equity beta? What is equity beta, class? 0. What?
0.8.
0.8. So what is the risk premium? Risk premium is 14. Risk premium is 14. So we can have the cost of equity.
Sir, it is not the risk premium they give us.
But this
Market
is market
return.
return on market, so not risk premium.
Okay, let me see now. So it is well. Market return 14 minus 6. Market return minus what? Risk free, right? So what do we have? What is cost of equity?
12.4.
12.4%. That will be the cost of equity. So we can now apply this now, right? We can say 12%, so that we just we can use what we can just say 12%. So what is the dividend for ZL? Don't forget that we want to value ZL, right? What is the dividend? What is the dividend in the income statement? Okay, 8,000 what?
420.
420.
420.
8,420. 8,420. Now, if you have 8,420, can you put the 8,420 here? The dividend that you have there is the total dividend. So get your dividend per share. Okay. Get your dividend per share. Just divide it by the numbers of shares so that you can grow your dividend. Okay. So anytime you are faced, what do we have here as dividend? What is the dividend itself? What is the dividend?
420.
No, what is the dividend figure? Is it 420 or what?
420.
8,420.
420.
Now, this is in naira. This is in value class. This figure is in thousand self. It's even in is a million, right? It's a million. So you can't put it here. You can't just say 8,420, 8,420,000. Then you now say you want to grow it. No, now, right? It is usually your dividend per share. Dividend per share. That is what you will grow. Your dividend per share that they pay you, you not grow it. They don't grow. You don't grow. You don't need to grow your what is it called? Your value, right? So dividend per share. You can meet your mic. Who is that? So dividend per share, right? So we'll divide this by the numbers of shares so that you will not divide it by the numbers of shares, which is 50,000 units. Oh, I say units. Unit and shares. No, come on. Man. It's still the same. So what do we have? What is the dividend per share?
0.17.
12.17.
0.17.
0.17 per share. So this is what you will grow. You don't grow value, right? You grow what they give you as dividend per share. If you look at it, even under the cost of capital, you look at it, it's usually dividend per share, right? So we can have 0.17. So what is the growth rate given to us in this question? What is the growth rate? What is the growth rate? What is the growth rate? 8%. Can you see? Is 8%? Is it 8%? That is 0.08. Let me check out my system. 0. So you can have here. So the cost of equity is 0.112. Then 0.08. So what is the market price? What is market price? What is market price?
0.89.
7.89.
0.89.
0.89 naira per share. So we can get the market value. Market value times 50,000 shares. So
Wait, I don't understand.
Inside bracket, this one they come from.
for my
From your own
where?
house that this one is coming from.
From my house, care. No, I never married now.
And the person should please mute. The person should please mute.
Okay. So, so what do we have? What is the market value? What is the market value?
4.133.
For 4.133, I think it's 4,000,000, 4,000, I'll be what? Sorry.
44,576.47.
44,
576.47.
Point what?
0.47.
Okay, we can just leave it like this. 44,557. Okay. Okay. That's fine. So if this is the
Sir, sorry, please. The cost of equity you omitted is 12.4, but you are using 12.
we don't round that up now. Just leave
Okay,
that for.
okay,
I
sir.
say more or 12%.
It's okay, sir.
But the amount is 44,500. Is a that figure.
Okay. Oh, so
Others should confirm, please.
For me, are you there?
Others should confirm.
Yeah.
That's what I got.
Now,
44,
market
500.
price is
44.5. 44.5. That's what I got.
4.5.
44 what?
500.
44,500.
Yeah.
Okay, 500. Okay, that's
Yes,
fine.
sir.
So, lastly, is based on, we should not forget that KL budget, what they have is just 230 million, and they are looking for investment. Now, they now say, oh, this cash, we can use it for strategic decision now. Is that also? We can use it to acquire another company. Now, the question now says, the examiner says that we should suggest if, what is it called? KK should acquire, what is it called? Should acquire ZL, right? I think that's the last, what is it called? Coming. Okay. Now, provide an evaluation of each of the three valuation methods from 1 to 3. Recommend whether KK should go ahead with the offer or not. So we can now compare. So this provide an evaluation, right? This provide what? An evaluation is just to explain each of the words, each of the methods, as well as including the value, the market what? The market value. Thereafter, we can now do what? We can recommend. So the next question here is on the present value of relevant operating cash flow for cash flows over 10-year period. Please pay attention to this part. So we have here 3, right? So we have 3 of the present.
Excuse me, sir.
Okay.
The market price for this thing is 4.59, not 0.89.
Yes, sir. Yes.
I've been giving you
4.59, sir.
attention, please.
4.59.
4.59. Yes, sir.
Then the total market value is 229,500.
So the total market value is what?
229,500.
Away. Okay. 229,500. Okay. The present value for 10 years. Present value for 10 years. Now, if we want to determine the present value, right? And we are talking about cash flow. And this is where we will start from, right? The post-tax or the net operating cash flow of ZL, right? After we have considered this, then we need to talk about the effect of acquisition. Of course, we have to consider all these effects of acquisition, because who will pay the staffs of redundancy fee? Who will pay it? They have to include it in the valuation. They have to include it so that KKPLC can pay. They have to include all these things in what? In valuation. Class. This is present value of future cash flow for 10 years. Class. So if we have this, this is what? This is post-tax operating what? Operating. Just like we say net cash flows after tax. Is that not so? You can see that in this question, we don't have, oh, we have to add back this, we have to less this. No, because they've given us the net cash flow, which is the net operating cash flow of what? Of 35,510. So therefore, we can start with that, right? Okay. Net cash flow after tax. Okay. So net cash flow after tax. We have, what is the next cash flow after tax? What is the net cash flow? Are we still together?
35,510.
35,510. 35,510. Plus. Then we have to add what happened, the effect, the expected effect of the acquisition are all the. We have to consider all this relevant cash inflow as well as the what? The cash outflow, because we have to consider it, because that is what we form our cash flow. Yeah. ZZ, Abi, is it ZZ or ZK? We need to pay for all those things, right? We have to pay the redundancy fee and all that. Now, class, let's start from the 50 employees. 50 employees of ZL would immediately be made redundant at an after-tax cost of 12 million. Is that not so? Meaning that they've considered it is after tax. Is that not so? It is what, class? It is after what? It is after tax. Redundancy fee. We can come here and analyze this way. Redundancy fee after tax. And you should not forget that redundancy fee is not from year 1 to, then we don't pay redundancy fee from year 1 to year 10. Redundancy fee is one of, that is at year 0. Redundancy fee is one of, which is what? At year 0. So we'll analyze it this way. Let me bring this down. So what is the redundancy fee after tax? What is the redundancy fee?
12 million.
12 million. Please, it is at year 0, because we don't pay, you don't pay a redundancy fee from year 1 to 10. It is at year 0, it is one off, right? And it is after tax. class, and it is what? It is after tax. So we move to the next one. So we move to the next one, which is okay, where we have the pre-tax annual wage savings are expected to be 7 point. Now, this redundancy fee, now, I want to remind you of our money and real. Now, you have a redundancy fee of 12 million. This redundancy fee, is it in money term or in real term, class?
In money time.
In what?
Real term.
Read
The retail, current prices.
Wait. Someone said, okay, now, no,
It's
wait.
it is only the annual wage savings that will be in current terms.
Okay. Now, Toyib, can you give us the reason why? Can you tell us the reason why the 12 million is a money term?
It is a one-off. It is a one-off transaction.
It is not like that, right? Toyib, can someone give us why is it?
It is not incremental. It's not incremental.
And
it's not incremental.
Thank you. And one thing about this thing is we should not forget that under money or way, I said it that when the examiner is silent about a cash flow, it is assumed to be what, class? It is assumed to be what?
Money.
Money. Right? I've said it. Yes, I mentioned this thing. I mentioned it in our previous class that you can assume to be in the money term, class. So it is what it is. So we need to move. So Mr. Moses, you've not been with us, so that we'll not be going back and forth, right? But you can unmute your mic quickly.
Okay, sir, sorry. My question is this. Since it's a one-off thing, it's not growing, it's not being affected by the inflation rate. So why are we having it as a...
It is one of. It is one of any cash flow given to you today, right? It is assumed that is the assumption. It is assumed that is in money term. Whether it is one off, it is not growing, it must not grow. Sometimes the examiner will be silent. I mentioned it, that the examiner may be silent about it. So when you see a cash flow like that, it is a money. It is assumed. If you check the notes under the inflation, the rules of inflation, it's there. See, it is assumed to be in money cash flow, right? Whether it's not growing or not, if the examiner is silent, you can see that the one of current price, the examiner indicates current prices for the one of current price. Mr. Moses, are you still there?
Yes, I'm good. I'm good, sir.
Yeah. Okay.
Thank you, sir.
Yeah, thank you. Now, I just want us to analyze it so that we just have an understanding of this question. Then we'll move from there, right? So, the pre-tax annual wage savings, they've not considered tax, and they said it is pre-tax. The first one of redundancy, they have to pay it out. It is a cash outflow, but it is after tax, right? But the second one, it is pre-tax, before tax. So that is the reason why I didn't add it here. So let's do something. This will be an outflow. Okay, I can have here effects of acquisition, right? Effect of acquisition. I will have to sign. Yeah, we have to sign. So pre-tax, because this is net. That is the reason why I didn't bring it here, because of it is net, right? So now, Pre-tax what? Is it what is the pre-tax? Pre-tax what class? Pre-tax class, are we still together? Pre-tax
Wages.
wages saved. This pre-tax, right?
Annual wages.
Well, no, it go like that. Annual wages, pre-tax wages saved. Fine. So what do we have here? What is the figure? What is the figure?
7.5 million. 7.5 million.
7.5 million. 7.5. Class, we should not forget that this net cash flow here is what? Is a money cash flow. Right? It is what? It is what? It is money cash flow, right? Or, okay, I'll get there. We'll get to that side. But let's move here. No, this is in current price, right? In current price, okay. So, next, what do we have next? What do we have next? We have some land and building of ZL will be sold for 8 million. Class, some land is also a one-off. Class, land is also a one-off. It is there. It is one-off. Right? It is a zero. Right? We have the 8 what? It is after tax. After tax, right? 8 what? 8 million. So you still come here and analyze it and say sales proceed on land. What is the sales proceed on land? After tax. 8 million. So it's an inflow, is a one-off, right? Now, if we have this, what do we have next? What do we have? After this, what do we have, class? What do we have? We have what?
Advertisement and distribution service.
Pre-tax advertising is also in current what? Is also in current terms, right? Is also in what? Is also in current terms, which is advertising. Per what? Per year. Can you see? The advertising is what? It is per year. So pre-tax, it is also pre-tax. It is per year. Don't forget that all these things we are still going to for how many years, for how many years, class? For 10 years, right?
10 years.
10 years. So you can include it in what we're doing. So there are two approaches to this question though. Pre-tax advertising. So what is the figure? Pre-tax. So are they going to save this as well? Is it savings? Okay, it's also saving. Pre-tax advertising. You know, it becomes an inflow, right? With pre-tax advertising. Okay, let's say savings in advertisement, right? So what is it? What is the savings? What is the savings? The figure, please. 1.5, right?
1.50.
Okay, 1.50. Remove that one. 1.5. 1.5. So we should not forget pre-tax saved, and we have pre-tax advertising. Is that not so? Thank you. For the for the foreseeable future. Okay. So now, class, this is savings, and this is also savings. We are yet to charge tax on them. So, addition of these two, what do we have? Addition of these two cash inflow, what do we have?
9 million.
Addition.
9 million.
So we can have 9 million. Okay. We can have 9 million, 9 million. Is it after tax? Okay. Tax nets, total cash flow. Sorry. 9 million, which is 9,000. So what is the tax? Tax is how many percent?
2.4%.
2.4.
No.
Away.
That's inflation.
Inflation. Yeah, that's inflation. Let's
But
check.
please, Mr. Ivy, the
33.
first one that is net cash flow after tax, why are we now adding with the pre-tax? Since this one, the net cash flow has been taxed.
Which one
after
are we
tax.
adding? Which one are we
And
adding? This one?
yes, the effect of acquisition, the pre-tax, you're adding pre-tax to the one that as total this thing.
No,
Total
no.
cash flow.
No. Which one? Which one of the total cash flow? I'm talking about these two. I just add these two together. These two.
Okay, sir. Okay. Yeah.
The tax is 33%. So what is the tax? What is the tax? Don't forget that these two are one-off, and it is even after tax. Now, adding this question now, this redundancy fee, it is pre-tax. This sales proceed it is pre-tax. We would have net it because it is one-off. We would net it. Then sales proceed too. If it is before tax, we would have done what? We would have net that one too. But we are not going to add it here because these two is just one-off. It is one-off. Once the acquisition does start, bam, everybody go. Right? Now, class, what do we have?
We have 2970.
2970. So, what is the difference? We give us the net
6030.
Okay, I'm coming. It's an interesting question. No? 6 what?
030.
30. So when you add this together, you will have your total net cash flow, right? So what is the total?
41540.
Okay, 41540.
540.
Right. Now, we should not forget that you have. Okay, I'm coming. 41540. Class. This is the net cash flow after tax. After the tax for 10 years. For 10 years. Because they will save this. They will save this. They will save this. And they will have this. This is what they will have. This net cash flow after tax, we have to do it for 10 years. It has to be do for what? For 10 years. So instead of say, 1 year, 2 year, 3 year, so we can, for us to discount it, we can use, for us to discount it, we can use what is it called? The annuity. Thank you. It is where you can use an imagine. You can use annuity, right? Thank you. I was thinking, how can you use to discount this thing? It is where. So now, class, are we still together? These two are one of class. Now, the question is, the next question we should ask ourselves, we have this. Oh, we are not done with the analysis, right? We are not done with the analysis. This is an interesting question. I just want you all to understand it. We don't need to come this thing, just to understand like why is it like this, and we move so that when you see this kind of question, you'll be able to at least attempt it, right? Now, 3 existing directors of ZL would it be paid 1 million per year for 3 years? We'll pay them, of course, because they have how many percent shares? They have 50%, right? So we have to pay them. The director, it will be an inflow to them. We have to pay them. So meaning that when you want to acquire ZL, these are the things they will consider in the valuation. You have to pay them off, including the directors. So we can come here and say, directors, these are one off. Let me use it. These are one off. Okay. Directors, right? Directors remuneration, we pay them 1 million, 1 million for 3 years. For 3 years, right? So this will give us what? 3 million, right? Is that not so? 3 million, right?
Yes, 3 million.
Yes.
Okay, please, who is against me in this class? So we have 3 million. Oh, where is it? Okay.
Is it for 3 years or before the 3 of them? He said 1 million naira each. That's going to be
For
3
the
million.
Yes.
Or I said for
The-
3 years.
Wait,
That is 3 million for 3 years.
Interesting. So the 3 existing directors of ZL would each be paid 1 million per year. Per year. Not per director, right? So they will share it. Right. So
I
this
thought they
will
said
give
it's
us
3 million each. 1
1
million
million,
each.
1 million each.
They say 1
That's 3
million each,
million
sir.
by 3 years.
Oh, Mukuna, calm down now.
Mhm.
The 3 existing directors of ZL would each be paid 1 million
Will
per
each of
year.
them.
I'm coming. You pay
Hey,
per year for 3 years.
That's one person 1 million, one person 1 million, one person 1 million for 3 years.
For how many years?
3
for
years.
For
3
3
years.
years. We are still
That,
saying the same thing. Is it
that's
not?
No,
3
that's 3
million
million
for
for
3
3
years
years.
now.
Yes, that is 3 million.
For 3
Mhm.
years.
Yes.
Yeah. That's 9 million total.
No.
Yes.
The question, the examiner did not say. Interesting. The examiner, look at, they say paid 1 million per year. not we'll pay them, not we will pay them, we'll pay the existing director, not that we'll pay them 1 million each.
Would
What
each
they did is
what
that
of
what
would
they want to
each
do, wait, this is the logic. This is the logic. 1 million per year for 3 years is 3 million. Each of them will share 1 million now.
No, they say would each be paid. Each, like 1 plus 1 million.
Okay. Please, who can interpret? Please, who will interpret this last part so that we can move, please?
AI.
What is AI?
Ah.
I don't understand. See, what is AI here? I mean, I want to interpret questions. There you. I beg. Now we see. Fumi, do you want to say something?
I just think the question says it all. Like each to be paid 1 million naira. Like 3 directors, 1 million naira each. 3 times 1 million. That's 3 million per year. That's my own thoughts.
Okay, that is 3 million per year. But the total amount is 3 million, right?
Per year.
Then you still
year.
multiply by 3.
Then for 3 years, that would be 9 million.
No. Kende.
Okay. The question is number 4, Abi. The
Yes.
3 existing directors of SLL would each be paid 1 million naira per year for 3 years. 1 million naira per. Remember, I mean, the first clause that comes is would each be paid. That is, each of them will pay 1 million naira. I mean, is it the total that? That means in a year, they will be paid 3 million naira. And they said they will be paid for 3 years. That would be 3 times 3. That would be 9 million. That's what I thought. Or is it that the 1 million naira that they will be paid will cover 3 years?
Yes, the 1 million. That is why they later add that clause of 3 years. There are 3 directors. We will pay them 1 million per year for 3 years. 1 million per year.
Oh. I think I'm trying to look at it from your view.
1 million per year for 3 years. We'll pay them 1 million per year for 3 years. For 3 years. So that is what it is. 1 million per year. So 1 million times 3. That is 3 million. So we'll not pay them 1 million each.
This English is not agree enter.
Okay now. Kende.
I mean the construction of these words does not suggest that that way that you are saying it to. It's as if they are going to be paid. They are going to be paid 1 million naira per year. I mean, that is what this the grammatical construction here is saying.
So you have
Mr. Ibrahim, please, let's agree that icon are confusing. That's just the facts.
No. Okay. That's fine. Let's just move on.
Mr. Ibrahim.
But this is
Mr. Ibrahim.
Okay,
if you are going to pay me 1 million naira for my service for an entire 3 years, I would have preferred that you do not include each year.
Thank you.
Or per year.
You understand?
I would have preferred that you say they will be paid 1 million naira for 3 years.
No,
I would have preferred.
In performance management, I don't know. I'm just looking at it. In performance management, when we're faced with a question like this, we look at what they tie. Like now, you said 2 naira per hour. They said per hour. So we attach that per hour to the numbers of hours. Is that not so? So Is that perspective I'm actually looking at it that, oh, the reason why that's each is just, I don't know, because they later add 3 years. Do you get? They now say 1 million naira per year. So it's for 3 years, we will not pay them 1 naira each.
Okay, sir. What would have been the 3 existing directors would be paid 1 million naira for 3 years. But now they said would each. That's one person 1 million, one person 1 million.
That each has its own meaning inside, to me.
The question would have been at the end of 3 years.
Now we got the reconstruct English for ICA.
So please let us move on, right? Yeah, that is how I understand the question. Like, honestly, I am not looking at it in that perspective. I'm looking at it in another perspective. That, okay, well, if we have 3 directors, you said we pay them each, right, 1 million. We pay them each 1 million, and they said it's for 3 years. That 3 years, they are not saying that you will pay them each for 3 years. They are not saying that, oh, that would be for 3 years. Okay, so we don't need to like say, oh, this is 3 director multiplied by 1. No, if you say multiply by 1, that one is per year. That one is per year. So the examiner says that the 3 existing directors of ZL would each be paid 1 million per year, and it is for 3 years. 1 million per year for 1 million per year times the numbers of years is 3 years. We will not pay them 1 million. That is what it means. Kende.
Okay, Mr. Ibrahim, are you now saying that for us to now get annual rates, I mean, maybe it's kind of information we are going to use. Are you now saying that for us to get annual rates for each of the directors, it will not be 1 million divided by 3?
1 million divided, for each.
That will be annual rate for each of them.
Yes, for each of them.
Hey, wow.
It's too small.
Me, I'm looking at it in, it's PM. I'm just looking at it like, okay, you said 1 million per year. We'll pay them each 1 million per year. The question is, how many numbers of years? Establish that. Oh, the numbers of years is 3 years. So which means, what is the numbers of that? That is why they said 3 years, because they knew that there are 3 directors. So
let's just move on, because this English will hurt us.
Okay,
just move on.
Yeah, now. Okay, no problem. That's fine. So we have 1 million. So this will give us 3 million for the 3 directors, right? So this is before tax. Of course, they have to pay tax on this, right? If the director is receiving a cash inflow, you have to pay them. Please mute your mic. Please mute your mic. Maybe. Okay, so we have to charge what? We have to charge tax on this. So what is the tax? 33%. So we can have the net. Of course, they have to pay tax. It will be net because it will be an inflow, right? So what do we have? 33% of 3 million. What do we have? Hello, what do we have? Quickly, please.
990,000.
990,000.
990,000. So what will be the net? What will be the net of tax?
2,010,000. 2,010,000.
Net director fee 2 million 10. Okay, after tax, right? So can we move? Are we still together? Class, are we still together, please?
We are
And we should
together.
not forget.
It's just
Okay,
English.
and we
You
should
want
not
me?
forget that it is just for 3 what? It is
We are
just for
together.
3 years. Net cash flow. Net cash flow after tax. Right. So net cash flow after tax, we have this. Oh, okay. And we should not forget that it is just for 3 years, right? It is for what? It is for 3 years. Okay. Now, if this is established, class, which kind of is this cash flow? Is it a money cash flow or a real cash flow? This cash flow here. We already established that this will be at year 0, which will still be the same amount. Is that not so? Now, this cash flow, is it a money cash flow? This 2 million and 10, is it a money cash flow or real cash flow?
It's money cash flow.
It is money cash flow. Why is it money cash flow? Why is it money cash flow?
Not given, we are not expressly given. We assume that it's money cash flow, and we're not giving any increment on it.
Okay, so we're given this cash flow. It is a money what? A money cash flow, right? It is a money cash flow, right? Now, class, this is, we should not forget that this is pre-tax wages, and this is in current terms. This is in current terms. Is that not so? Good. Now, what is the next step? What we are going to use to discount? We should not forget that this is in money terms. Is that not so? We have to discount. Are we not going to discount our cash flow? We have to what? We have to discount our what? Our cash flow. So to do this, let's do something. The present value of future cash flow. That's what they say at tense. We have this. We have this. Now, the first one we pick is the net cash flow after 10 years. The net cash flow after 10 years. So what will be the DCF? So what is the net cash flow after 10 years? The figure we got in that part is what? What is the figure? 41,540. 41,540. Right? So we have to discount it so that we get the what? The present value. DCF. Okay, should we use that other method? Whichever method it will work out. Okay, so we are going to discount this to the what? To the present value. The question is, what are we going to use to discount this our cash flow? If we want to discount this to the present value, what are we going to use to discount? And we should not forget that this cash flow here is in real term, right? Is in what? Is in real term. And this one that we have here is in money term, right? What we have here is in money term, while what we have here is in real term, class. And This is just a
Sorry,
one-off.
sir. Sorry, sir. The 35,510 is in money term.
I'm coming. Okay. The 35,510 is it in money term?
Yes.
Is it money term? Okay.
Yes.
Okay, interesting. Okay. Okay. That's fine. That's what should we do? Should we is a money term? We can pick this part of it and what should we do? Okay, that's fine. So we should determine the weighted average cost of capital. Let's see what's information given to us in this question. We are talking about a company here. Is that not so? The acquisition is on company, right? So we need to determine the weighted average what? The weighted average cost of what? The weighted average cost of capital. Now the question is, did they give us an ingredient for calculating weighted average cost of capital? Any ingredients?
Yes, sir. I think
Okay.
from their financial state.
Okay, that's fine. So, the discount. Okay. Okay. So this is in money term, right? They gave us this in real term. Interesting. Let's just do something. Okay. Let's say okay. This is in real term. This is in money term. Then we have this as one-off. Okay. Now, in order to make these things easy for us, right? Let's calculate the weighted average cost of capital, because this is to the firm. They want to acquire. It is acquisition, right? It is what? It is acquisition. And you can see from the information given to us, you see the long-term finance. The bank loan is already there. Is that not so? The bank loan is there. So they didn't tell us that. They didn't tell us this is acquisition. If you're acquiring a company, you're acquiring it, both the shares and the debt. However, in some question we state that the company just want to acquire the shares. Class. The company just want to do what? The company just want to acquire the what? The shares. So if they say the company just want to acquire the shares, that means we are going to use the cost of equity to do what? To discount it, right? Now, class, how do we determine the weighted average cost of capital? Whack. Where should we start from itself? Okay. So, weighted average cost of capital. I beg. So, weighted average cost of capital. We'll do it one after the other. Oh, you get it. So, what is our formula for calculating weighted average cost of capital? We have to discount, right? What is our formula?
Cash total.
No.
Cost of equity multiplied by value of equity plus cost of
value of. Okay, let me just copy. Value of what?
Cost of equity multiplied by value of equity.
Cost of equity
multiplied by value of equity
times value of equity
plus cost of debt into 1 minus tax times value of debt.
I don't know. Let me just copy the formula because my keyboard. I don't know.
And divided by value of equity.
Are we not using the table format?
No. That one we waste time now.
Okay.
That one we waste time now.
Okay.
So Plus what? Sorry. This
Cost
is
of debt
divided by.
1 minus tax.
Okay, that's fine. Value of equity
Plus value of debt.
plus value of debt. Let me just copy my keyboard. Let me just copy the symbol there. Oh yeah. So just one question since, and this is to 11. Interesting.
Yeah.
Yeah, interesting.
This right. SFM is in trouble.
Swear. Okay, so I like that, you just have to build up the confidence, right? So you can do it. So there's nothing in SFM, honestly. Honestly, there's nothing there. So what is our value of equity for the company? Then we have the value of debt. What is the market value of equity? Quickly. That's why it's compulsory question.
I think 229 or something.
Okay. So we're given the market price. Is that not so? If this is the market price, we just multiply by the numbers of shares. Is that not so, class? So we have the market value of equity. Is that not so? Away.
Yes, sir.
Okay. This is 370 cover, right? So 370 cover. I'm supposed to do this thing first before all these things self. That's fine. That is 3.7. I've converted it to naira, right? Times what is the numbers of shares? The numbers of
50,000.
50,000 shares. 50,000 shares. So what do we have?
185,000.
185,000. So value of debt. Value of debt. So we're given the what? The which information? Value of debt. How do we determine the value of debt? What is the debt given to us for ZL? We only have bank loan, right? Is that not so, class?
Yes,
Yes.
bank.
So what will be the market value of the
Yes,
bank loan? What will be the market value of the bank loan?
that would be
35,000.
75,000.
35, 35.
35,
35.
thank you. Yeah, thank you. 35,000. You can't determine the market value of bank loan, right? It's still the same amount. You can see this is ZL.
because it's non-trade loan.
Yeah, it's not traded. Yeah, it's not traded debt, right? So 35, 35, 35, 35. Okay. So we have 35,000. Right. So after this, what do we have again? We already have our cost of equity to be 12%. 12%. What do we have again? Okay, I think that's all. So our tax is 33%. So I can use this table to get my DCF. What do we have here? So
Actually, what about cost of debt?
okay, thank you. So what will be the cost of debt?
11%.
11%.
Okay, 11%. So it is even the 11% is they didn't state it wasn't stated that it is pre-tax or after tax. So it is only we assume that the 11% is pre-tax, because if it is post-tax, it would have been stated that this is post what? This is post-tax, right? So 11%, right? So the market value of equity is 185,000 times the cost of equity is 0.12, right? We have here the value of equity. Value of equity is 185,000. Value of debt is 35. So we still have this. Oh, we can have 185. 185. This is 35,000. Right. So we have here value of debt 35. So times cost of debt is 11%. That is 0.11. So tax rate is 0.33. So what do we have? What is the weighted average cost of capital? Oh, excuse me. What is weighted average cost of capital? Quickly. Oh yeah, now. Oh yeah, oh yeah, oh. What do we have?
$11.26. That can confirm. 11.26.
0.26.
Yes.
Or
No, 26.
okay, 26. Oh,
yes.
26. Others should confirm 26. That is 11%. Please, do we have anyone in this class? If you're in this class and you did not understand what we're doing, please can you mute your mic and speak up, please?
I'm lost though. I'm just looking at what you're doing.
Where did you lose? Where? Which part? Is it the weighted average cost of capital or the part of directors?
Mr. Ibrahim, we will be fine.
Okay. Okay, what do we have here? Is this 11%?
Yes.
Yes, sir.
Okay. Okay, can we move? Okay. Now, the question now is the cash flow that we have, this weighted average cost of capital. We should not forget that if you have
Please, I cannot hear anything. I don't know if it's from my end.
Okay. Now the weighted average cost of capital that we have here, is it in money term or in wage term? What we calculate here, you know, we are, of course, we already have all these cash flows. We already have all this cash flow. This is given to us, and the law says that when you have a cash flow like this, right? And in fact, it is even stated that it is not expected to increase. Is that not so with what? With inflation. This is a money cash flow that we have. Now, at the same time, this one that we have here, it is just one off. This is just at year zero, what we have at year zero, right? Which, if you multiply the 12 million times any DCF that you want to use, we still give you 12 million, because it will be at year zero, because it is one off. Is that not so? And we equally explain this, that these two, according to the question, these 2 year given to us, the 2 year given to us is what? It is in current terms, which is in money term, right? And Toib now said, no, because I wanted to add these two together and say, oh, we added these two, and I said, oh, this thing should be the two, the addition will be in what? In money term. You now draw my attention to it that, oh, the net cash flow after tax is the one we picked from the question, right? Meaning that if we have any net cash flow given to us, it is assumed to be in what? It is assumed to be in money term. Plus, it is assumed to be in what? It is assumed to be in money term. But we have this 2 year. That is what? That is in current term. So meaning that we have two options. There are two ways we can solve this question. Like I said, I can convert everything here so that everything will rhyme, right? Now, the question now is, this work, is it a money work, or is it money cost of capital or real cost of capital? That is the question. Class, is it a money or real?
Money.
Is a money cost of capital.
Yes, sir.
Right? Is a money cost of capital, meaning that we have to use money cost of capital Oh, my village people are after me. It is well. So the 11% that we have, right? Village people where they never see food chop. Kendi, are you still in this class? Okay. No.
I'm still here, sir.
Okay, that's fine. So the 11% that we have, right? We should not forget, it will assume to be in what? In money terms. So meaning that we count our cash flow. You use money for money and you use real for real. That is how you do it. You use money for real, money for money, and real for real. Or in another case scenario, since we have here this work to be in money term. Now, the pre-savings and advertising, we can convert it. We can convert both of them to money term, money cash flow, so that we can use the money cost of capital to discount the money cash flow.
That would be better, sir.
Or we can convert this to real cost of capital so that we can use it to discount whichever way. We have two options here, right? Now, this is in money already. We don't have problem with this. We'll discount with what we have, which is according to what you guys gave. You gave me what? How many percent? Give me 11%. Right now, we don't have challenge. We don't have problem with this. We will discount with 11%. Now, this one is one of is year zero. It's still going to give you the same figure, the same amount. It's just year zero, which is 12 million. We don't have issue with this class. Is that not so? Now, next is this. This is in money. This is in real cash flow. The 9,000 naira here, class. The 9,000 naira is in real cash flow. Why? What we pick, because it is stated in the question. It was stated in the question that these two are in real term. Is that also why this we pick it from? We pick it from the financial statement. Is that also which we assume that the 35,510 is in what is a money term. Can we see? So we have two options. We can decide that, oh, this 9,000 naira that we have here, right? This 9,000 naira that we have here is in real term. We can convert it to money cash flow so that we can discount everything with what? With 11%. Or we can convert the money weighted average cost of capital to real so that we can use it to discount the 9,000. Then we use money to discount money. So which one are we going to use now? So now let's start so that we don't waste our time. Let's start with the first one where we have 35,000. Let me just pick it from here. 35 35 what? Class. 35 510. Is that not so? Are we still together?
Yes, sir, we are together.
Okay, that's fine. 35 510.
But any moment we can be against you.
It's fine. So 35 510. Is that not so? So we have to do what? We have to discount. This is in money term, right? This is in money term. We have to discount this CF with 11% for 10 years. So what is the DCF for 10 years annuity? If you use 11%, what do you have? What do you have, class?
Sorry, Mr. IB, if I can get you right, the work that we got is you say is real.
No, it's a money term now.
Then why are we discounting this one? Are we not supposed to discount this one that is in money?
This is the money. This is a money.
Yes.
Is this not the money? We want to discount it.
Using 11%.
Yes, that is money.
Okay, sir. Okay.
This is money, right?
Yes, sir. It's confusing me with the other 11. That's
okay. That's fine. So what do we have? Yeah, okay. So what do we have quickly?
5.889.
5.889. 5.889. So when you multiply, what do you have? If you multiply this, what do you have? What will be the present value for this? Net operating. Let me use this one. Operating cash flow. Okay. If you multiply his class, what do you have? What do you have quickly?
209,118. 09118.
09118. Okay, that's fine. Oh, okay, that's fine. So we need to go back and pick, since we will not join them together, right? Now, this 9,000 naira, okay, no, it's tax now, nets. So the nets that we have from the effect of acquisition is 610. And this 610 is in what? Is in real term. Because the 7,500 is in real term. The 1,500 is in real term. And this system is in what? Is in real term. Is that also class? So how do we do this? Should we convert this real to money? All right? Should we convert this real cash flow to money, or we convert the money cost of capital to real?
Let us convert our work, sir. That will be straightforward.
Class, are we good? Should we convert our work?
If we convert our work, what about
Yes, sir, let's convert our work.
Okay. Won't it have effect on the first one that we have done, sir?
No. The first one that we did, this is in money. Is that not so?
Yes,
this
sir.
is the net operating cash flow
Yes,
after
sir.
tax. Is in money. So we use money to discount it.
Oh,
Is that not so? We use money to discount it. So money cost of capital is this. Now let's convert. Conversion to money to real cost of capital. Right? So real cost of capital. What is the formula?
1 plus m divided by 1 plus I minus 1.
1 plus
M.
1 plus MCC.
Yes, divided by 1 plus I.
Okay.
Minus 1.
1 plus I minus 1. 1 plus I. Okay. As you are tired of this question, I'm also tired of. Well, we must finish, must complete it, right? So, I actually plan to solve the questions, but that's fine. So, if we have this, right? The real cost of capital, the money is 11. So the inflation rate, they gave us inflation rate in this question. What is the inflation rate? What is the inflation rate? 2.4%. So 2.4% is equivalent to 0. What?
0.024.
0.024. So what do we have? What is the real? What is the real? What is the real cost of capital? Class, what is the real?
0.0839. 4. 0.84.
Yes.
0.084.
84. Yes.
So this will be how many percent? 8%, right?
Yes, sir.
8%. So we are sure that this 11% is 11%, right? So if we are sure, we are good then. So if we have this to be 8%, so the next thing we need to do is to discount this two here, this two here. All right, and that is the effect of acquisition. Right, let me put effect of acquisition. This will be note what? I didn't note it. Okay. Effect of acquisition. Let me just say effects of acquisition. Let me use it. What is the amount? 6,000 what? 6,030, right? 6,030 savings, because it's in current term. It's in current term, so we need to use 8% to discount DCF. 8%. Don't forget, we'll be in for 10 years. DCF for 10 years. So what do we have here? What do we have? What do we have? What do we have? 1107. Wow. What do we have?
482.4.
482. No. DCF 482.4. I don't get 48. That is 48.
482.
It's
I don't understand.
6.710.
6.710. So if we have this, so what will be the present value? If you multiply it, what do you have?
40,461.
461. Class. Okay. You can see that we use money for money. We use real for real. You can decide to convert this system to money cash flow, so that you use 11%, you move. Right? So that you do what? You use 11% and you do what? You move from there, right? Damilola. Can hear you. Please mute your mic quickly. I still can't hear you, please. So I can't hear you. Director's net cash flow after tax for 3 years. The director 210. 210. So what will be the DCF? Because it is a money term, right? It is not expected to increase. It's a money term, right? So 11% for 3 years, right? What do we have?
2.444.
2.444. So what do we have?
4,912.
4,912. Good. Now, what's next? We need to pay redundancy fee. All this one will be at year 0 class. So we need to copy this. So I just need to put it down. Redundancy fee and 12 million. So this is 8 million positive. Right. Class. So what is the present value of future cash flow? I think we are done with all this information here. So what is the present value of future cash flow? What do we have?
274,491.
274,491. That will be the present value of future cash flow for 10 years. So, any other question? If you have question, you can unmute your mic quickly, please, so we can leave this class, please. Question. Which one? Is it negative? This is cash flow. This is cash flow. This is cash inflow. This is negative. This is positive. So,
Director, when they pay them, is it not outflow?
No, we pay them. Is it supposed to be an outflow?
Is
we paying the director?
Is what?
Is it outflow?
No, it's an inflow. It's an inflow. We have to. Who are we paying? Who are the directors of the company? Are they not the owner of the company? They are the owner now. They will receive their cash inflow. It's an inflow that they will receive. Do you get? Like now we have net operating cash flow.
An inflow, is it not to their individual accounts? It's not into the company now.
Redundancy fee that we paid out. We paid it out to staff. We paid the redundancy fee or any other fee that you are paying. You paid it out to staff. We are talking about the directors. Directors are the owner of the company now. Their money. Whether they paid it out or not, is their money. We are talking about what we will pay them for that 10 years. It is their money. It is an inflow. It is their business. Is that not so? They are not paying anybody.
Okay.
Do you understand? If it is advertising expenses, redundancy fee that you paid outside, it's an outflow, so it's going out. The directors are the owners of the business, and that is what they will receive. It will become an inflow. If you say that it will be an outflow, that means that you are not recognizing it for them. If you say it is an outflow, it is their company, so it should be added to the what, to their operate or what is it called, cash flow, right?
Okay. But we put it in brackets. It's in brackets.
Where
no, it's not in brackets.
It's not. This is a redundancy fee that I put in brackets here. Mr. Timitope.
Calculation is wrong because I added the 12 million, the 12,000.
Okay. Now what do we have? This is the negative part is just this redundancy fee that they pay us. What do we have? Someone should confirm it now so we can.
5491.
250,491.
491.
250. Okay. 250,491. So are we? You can go and confirm this. I have reservation here that this 11% is supposed to be 12%, but then just check it again. If yes, this should be 12%, but just check it again if we made a mistake here in the calculation, right? So that you can effect it, right? So what is most important is for you to understand the process and how it looks like, right? So we should not forget that we pick this in summary. This cash flow that we pick from the financial statement is in money term, because it wasn't stated that okay, this is this is that, is also. So we have to discount it with the money cost of capital. Now, in the effect of acquisition, we have some current terms, which are pre-tax advertising, which are savings, and they are in current what? In current price. So that is the reason why we have to convert to real cost of capital, so that we can use real cost of capital to discount real cash flow. At the same time, we can even convert that real system. We can even convert it to money cash flow. So once you convert it to money cash flows, then you
Mr.
can convert,
Ibi,
right?
please, hello, Mr. Ibi.
Yeah, I'm with you.
Yeah, please, in that cost of debt that we used to calculate
Okay.
that work, I thought
Uh,
the cost of debt we are going to use is for that of the bank loan. I don't know
yes.
the figure there.
Okay, let's check. The bank loan is, this is the value, this is the
It's
market value.
10%.
Is 10, no, it's not 10%. Oh, is it 10%?
10% bank term
Oh,
loan.
okay. Is it 10%? No. Is it supposed to be 10%? We are talking about company, right? Is it supposed to be 10%?
Okay. Is the this thing? Okay,
This
I've
is
checked.
this
Okay,
is
I've seen. Okay, it's 11 for the ZK.
yeah.
ZL. Okay, it's 11%. Okay, sir. Mm, mm. I was
So
looking at it.
okay. So you can check, you can check. So any other question? So can we go? So you can also check it. You can go back to it and check. You can check. So on this note, I think we have to go. Thank you so much, everyone, for joining,
Thank you
and
so much, sir. Mhm.
uh,
Thank you
enjoy
so much.
enjoy the rest of your
Good night,
evening.
sir. Yeah. Good morning, sir. Abi, good night.
Thank you,
Good
sir.
night.
Thank you so much.
Yes, sir.
It is well. Yeah,
Good.
see you tomorrow. So I will move to merger and acquisition. Thank you.
Okay, sir. Mm.